Hello, all of you savvy investors out there. Welcome to Investing Lighthouse, where we explore the world of investing. Ready for another dose of financial wisdom? Today, we've got a hot topic that involves none other than the stock market maestro, the investing virtuoso, the Oracle of Omaha himself, Warren Buffett. Strap in, my friends, because we're going to explore why this stock-picking wizard tells most folks to, well, not pick stocks. That's right, folks. Let's dive into the sea of passive investing and uncover the treasure of knowledge that lies beneath. Now, Warren Buffett, as you may know, has made a pretty penny, or a few billion of them, by hand-picking stocks. He's like a truffle pig for undervalued companies. But here's the kicker. He doesn't think most people should try to mimic his strategy. It's a bit like Lionel Messi saying, "Don't try this fancy footwork at home, kids." Why? Because playing the stock-picking game requires a temperament as cool as a cucumber in a freezer. It needs the patience of a saint, waiting for the perfect investment, the audacity to go big when it comes, and the nerves of steel to ride the roller coaster of market volatility. It's a tall order, and Buffett knows that not everyone is cut out for it. Are you still thinking about putting your stock-picking skills to the test? Consider this nugget. Between 2000 and 2020, only about 20% of large-cap fund managers outperformed the S&P 500. And that's their full-time job. Even among these elite few, consistently beating the market was as elusive as a mirage in the desert. Plus, they charge higher fees for their services, which can eat into your profits like a hungry caterpillar on a leaf. So, what is the Oracle's advice for the rest of us mere mortals? Well, it's surprisingly straightforward. Passive investing. Now, before you think we're suggesting you invest while you're lounging on your sofa, let's clarify what passive investing is. It's about buying into an index ETF, a fund that mimics the performance of a market index, like the S&P 500. Instead of trying to outwit the market, you're just going with the flow, cruising along with the overall trend. These index ETFs are not the new kid on the block. They've been around since the 1970s, providing investors a way to get a slice of the whole market without needing to be a stock-picking prodigy. And boy, did they catch on! Fast forward to 2020, the total value of assets held in US-listed ETFs surpassed an astounding $4.4 trillion. That's trillion with a T, folks. Why are they the toast of the town? They're easy to get, simple to grasp, and they offer diversification. That means instead of putting all your eggs in one basket, you're spreading them across many. Lower risk, lower stress. But wait, there's more. Buffett also endorses a little strategy called dollar cost averaging. It's like your regular subscription to your favorite magazine. But this time, you're subscribing to shares of your chosen index fund, regular investments, regardless of the market mood. The beauty of this? When the market's down, your fixed amount snags you more shares. When it's up, fewer. Over time, this can lower the average cost you pay per share. And here's the final piece of the puzzle. Passive investing isn't a get-rich-quick scheme. It's a gradual wealth-building strategy. It's about letting the magic of compounding do its thing over the years, even decades. It's more of a tortoise than a hare in the race of investing. But remember, my friends, no investment strategy is a magic bullet. Index ETFs are great, but they're not perfect. They follow the market's highs and lows. And while you're spreading risk through diversification, you're not eliminating it. It's like wearing a seatbelt. It reduces the risk, but does not prevent accidents. You see, passive investing also comes with its own set of risks. When you're buying an index fund, you're buying everything in that index: the good, the bad, and the ugly. During a market-wide downturn, there's nowhere to hide. Your investment can still lose value. Remember, my friends, no reward comes without risk. Okay, let's put on the brakes for a moment, folks. Imagine you've got a wad of cash ready to dive headfirst into an index fund. You might be tempted to put all your eggs in one basket right away. But remember this, it's not about timing the market, it's about time in the market. Let me explain. The S&P 500, the big kahuna of indexes, has had an average return of around 10% per year over the past century. But here's the kicker. That 10% isn't consistent. It's as erratic as a squirrel on a double espresso. In some years, the S&P 500 has been on fire, producing returns well north of 20%. Think 1995, when the S&P 500 soared by over 34%. What a ride, right? Or 2019, with a whopping return of nearly 29%. But then, there are the years that make us want to curl up with a tub of ice cream and forget all about stocks. Remember 2008? The S&P 500 took a nosedive and posted a return of minus 37%. Ouch. This is the roller coaster ride of investing. One year, you're on top of the world. The next, you might be wondering why you didn't just stash your cash under your mattress. And this, my friends, is exactly why you shouldn't invest all your money at once, even in a well-diversified index ETF. Spreading your investments out over time can help you ride out those market troughs and reach for the peaks. It's all about balance. Like a tightrope walker at a circus. Dollar cost averaging is like a disciplined workout routine for your investments. Just as you don't expect to get fit overnight, you shouldn't expect instant results from your investments. But over time, by investing a fixed amount regularly, you can potentially lower the average cost per share you pay. You buy more when the prices are low and less when they are high, making market timing less of a concern. So there you have it, folks. While Warren Buffett might be the poster boy of stock picking, he knows it's not a game for everyone. Instead, he advocates for passive investing, a strategy that's simpler, more accessible, and based on the stats, more likely to yield good returns over the long haul. It's a bit like going on a scenic road trip instead of a high-speed car race. You get to enjoy the journey without the stress of trying to outpace everyone else. Ultimately, isn't that the desired outcome we all seek from our investments? So, next time the world of investing feels overwhelming, remember Buffett's advice. Sometimes, it's better to go with the flow than try to swim upstream. We're eager to hear your thoughts and feedback, so please feel free to leave your comments in the section below. If you found this video informative and useful, please show us some love by smashing that thumbs up button and subscribing to our channel. Thanks again for watching, and we look forward to seeing you in the next video.